Have a listen to this. Have a listen to this.
Now, that kind of talk this week dragged Australia's share market to a two-year low. There are, of course, complex reasons for that.
He was the big spender. Right. The big spender.
Doing the grocery shopping could take a huge chunk out of the family budget.
And that's finance.
Hello and welcome to Comedian versus Economist. We demystify the world of money and help you get a handle on the bigger picture. My name's Adam and we're joined as always by my little older brother and real life economist, Thomas. Hi, Thomas.
Yeah, g'day, Adam. How are you?
Pretty good, thank you. Thomas, today on the show we're going to be asking you, it's buyback season. What does that mean for us? Is it true that China has become uninvestable? And the e-postman has been to visit and dropped off a few digital letters in the virtual mailbox, which is just another way of saying we've got a few emails to cover off. But first, Thomas, consumer and business confidence data is out this week. How are we feeling?
Yeah, a bit glum actually. Not too chipper on the latest data. NAB has a business survey, and that confidence measure that turned negative first time since mid last year. Right. And the biggest monthly fall since probably April 2020. So normally this series is pretty stable, but it's lurching around all over the place. So it dropped right through the floor in April 2020 and then bounced back. And by the end of 2020, it was in the positive, and then up until recently was at some of the highest levels on record. So businesses were super pumped. They were super confident about the outlook. But that's all unwound in the recent month, and we're now back in the negatives.
We asked 100 people locked up at home, how confident were they? It's not rocket science, is it? Like, did we really need a survey to find this out? It gives economists something to do, I suppose, during the lockdown.
Yeah. Some data to crunch. I mean, it is interesting. I mean, it's interesting because it bounced back so hard, right, and because there was so much money in the system, and you know the corporate sector's doing pretty well. Particularly big corporations are going great guns. We're seeing that in the reporting season at the moment. Yeah. So, and you might think that if lockdown's looking like it's going to be temporary, then there's going to be a big bounce back on the other side, and that businesses might look through that and temper their emotions around it. But it looks like they haven't. It's gone negative to, apart from the COVID drop in 2020, probably the lowest level since 2013. So it's not panic stations. It's not like they're back at like where they were last year, but it's definitely dropped off significantly.
So they're quite separate things, like business confidence and consumer confidence. Do they kind of track together, or are they very different beasts?
No, I think they're pretty similar. Yeah. I mean, yeah, I think they tend to move together. Yeah, actually, that's a good question. I don't know if anyone's ever looked at the formal relationship between the two.
What? We got all this time on our hands. We're surveying people who can't go outside to see how they're feeling, and no one's looked at whether or not there's a correlation between consumer confidence and business confidence. Surely it doesn't take me to come up with those kinds of ideas, Thomas.
No, there definitely are, but it's kind of like, why would you bother? Like, what does it prove?
That's my wheelhouse. Why would you bother? That's me.
Yeah.
Bothering where others wouldn't.
But yeah, but that's right. Consumer confidence, the Roy Morgan survey, that dropped off a cliff as well.
Right.
Again, not to like panic stations levels that we saw in 2020, but certainly a sharp drop off. Yeah, lowest level in many years. So, yeah, consumers and businesses are looking at what's going on with the lockdowns and feeling a bit nervous about it. The other thing that's in the worrying thing is that forward orders are down as well in the business confidence, in the business survey, and so is the employment outlook.
What are forward orders? Is that like lay-by?
Yeah, no, it's just about the outlook for Afterpay. Just ask companies, you reckon Afterpay, should I buy Afterpay?
What are forward orders?
Oh, it's like, you know, the orders coming in for products to be delivered, okay, you know, in the future.
Right. Yeah.
Yeah. So like, what's the forward order book looking like?
Right.
Yeah. That turned down pretty significantly, and the employment sort of did as well. So it means that businesses are a bit nervous. If they were looking to ramp up employment, they might be putting that on pause for a bit. We probably know that unemployment's going to tick up in July. We get that later this week. and that then feeds into consumer confidence as well. So, yeah, long story short, the lockdown's having an impact. I mean, I get you saying there's no surprises there, but it's significant. It doesn't seem at this stage that people are looking through the lockdown to the other side and just going like, oh, we'll just ride this out and we'll be right. It seems like people are genuinely worried and this is going to turn into a long-term thing. And a lot of people now are saying that we're locking in a double dip recession, which is a couple of weeks ago when we were talking about this, it seemed like we're definitely locking in a negative September quarter. December quarter was still a sort of line ball, depends how it goes, but New South Wales is still going in the wrong direction. So now a lot of people are talking about that double dip recession.
Right. And so March 2020, obviously the share market fell off a cliff and then bounced back. But are we looking at big impacts on the share market as a result of this kind of confidence?
Not as yet. Not as yet. I mean, this is something I've been wondering about this week. Like, are we going to see a repeat? Markets tend to be able to look through the noise a bit better than consumers and businesses, I think. And particularly because we know that if there's a sort of perverse sort of reality that happens, that if things get bad enough, then the government will come in with even more money, which is good for valuations. So a lot of, I think, markets at the moment will be looking through that and kind of balancing that, saying like, well, it's temporary, we'll probably get through it. We know that, even with the worst of 2020, a lot of businesses were going great guns. Like a lot of businesses had their best year ever.
Yeah. Is it also, is that because as well, we didn't know in March 2020 what the government response would be? Like we didn't know whether they'd fire up the money printing machines.
Yeah.
Whereas now we can pretty safely say, well, they haven't turned them off.
Yeah. It's still warm.
Yeah. So there's more confidence in the fact that the government will provide that money support.
Yeah, I think that's right. The safety net's there. Yeah, and I think the market sort of recognise that.
The rest of the world's doing okay as well. I mean, when COVID hit in March 2020, the whole world went, like that kind of simultaneously. There was panic across the globe. Whereas, unfortunately, we kind of find ourselves now in a state where we're not doing as well as other countries in terms of our vaccinations or dealing with COVID. So you can see the US opening up, the UK opening up, other European countries. So because they're sort of functioning and the economy is still ticking over, maybe we won't see the same tank.
Yeah, I think that's right. It was genuinely terrifying, the pandemic, because it was such a global phenomenon. And yeah, I think, markets were right to totally freak out. This time around, as you're saying, this is an Australian story. We're lagging the world now. We had the, gold standard best case scenario in Australia through 2020. We're, envy of the world with the sort of freedoms we were able to enjoy. But now it looks like we're kind of lagging behind a lot of the developed countries because the vaccination rate is still too low. And this is still something I wonder about. Like, it's not a settled question for me. Like, we're, in New South Wales, they're saying, well, we just got to learn to live with COVID now, and we'll get our freedoms back once we get vaccination rates up above 80%. And that still seems like it's a way off. But even then, there's no guarantee that that's the case yet. It's still a hope. And it still feels like we're sort of clutching at straws a bit. In New South Wales, they want to learn to live with the virus, and that depends on vaccination rates. In WA, they're saying they still want 0 cases and no COVID, and that's what they're gunning for. So there's a real sort of fracturing going on, and yeah, it's a challenging time for Australia, I think.
There's lots of ideas now, at least, coming out about how to get people vaccinated. Last week, we obviously, we covered off. And the opposition was suggesting $300 a person. So that's kind of the way out of this, right? It's just to get vaccinated.
Yeah, that's the hope. That's the hope. I mean, we talked about that last week with the behavioural economics mob, but it was revealed later in the week that Scott Morrison had actually talked to Tab about rolling out a lottery.
Tab the bookie? The
bookie, yeah. Floated that idea, wanted to see if they thought it was a goer.
Was he talking to Tab, or was he just talking in a tab? I can just imagine him inside one of those tab shops, just surrounded by TV screens, looking for tips. Anyone got a tip for race 5? And anyone got any ideas for how we might get increased adoption of vaccination across the country? What's he talking to Tab about? Score a $50 bonus bet if you get your COVID jab. Yeah. Chuck your COVID winnings on a same race multi. Oh, nice one.
Well, Tab used to be a public entity. Like, I think they're privatised now, but they used to be an arm of the government back in the day. Yeah.
All right, perhaps we should move on. We better put a pin in that and leave that behind us, Thomas. So, look, let's talk share buybacks. We, dare I say, called it a few weeks ago when ANZ announced that they were doing a share buyback. We started looking at what a buyback is, when you might do that kind of thing. Since then, it's all kicked off. Buybacks are hoi hoi, Thomas. What's going on?
Yeah. I think we did call it. I said I thought it'd be the thin end of the wedge. We're now in the thick end of the wedge, it seems. Yeah, going with reporting season. So companies are announcing that they're going to buy back shares. We've got sort of the big 10 that have announced this year so far are collectively purchasing $13.3 billion.
Ooh.
Yeah, so a lot of money. Commonwealth Bank last week was far and away the biggest of those. We said we expected a big number from CBA, and they delivered. They got $6 billion they're buying back from the market. That's on top of another $4 billion they're distributing in dividends, meaning they're handing $10 billion back to shareholders, which is bigger market cap than most companies on the ASX 200.
Yeah, wow.
They're just giving it away.
Can I invest in the company they've created for the share buyback?
Yeah, so that's going on. But yeah, there's a bunch going on. NAB came out 2.5, ANZ 1.5, which we covered off. Suncorp 250 million. Telstra late last week with 1.35 billion. Yeah, and that's not the end of it. But like, there's a lot of expectation that some of the miners, BHP, Fortescue Metals, South 32, are going to have a buyback. Woolworths are expected to have a buyback as well.
Right.
I saw one estimate saying that they expect that at the high end of that could be another 6 billion on top of the 13.3 we've seen. So a lot of money going back to investors at the moment. On top of that, dividends have been in line, if not better than expectations as well. So
in line, if not better. Didn't CBA pay out double dividends this?
CBA, yeah.
Yeah, sure. Just massive flex. Oh, whatever. Let's double it. Tell you what, double it. I've been talking to Tab as well.
Yeah. But profits are up. It's been a great year. Companies are flush, and they're returning that money to shareholders. That's what's going on, either through dividends but also through buybacks.
So it seems like there's no one's worried at all that this won't end well. Like last week or a couple of weeks ago when we talked about at the ANZ buyback, we had a look at some of the stuff that happened historically in the US, and the SEC got involved, and there was some kind of, and I think some of the data, in fact, said, that post the buybacks in sort of, another 10 years or whatever, that in hindsight, it didn't seem like it was such a crash-hot idea. The share price didn't sort of do what it was meant to, underperform. So there doesn't seem like there's any of that fear. It sounds like everyone's just piling in on all aboard the buyback train. There's none of that?
I haven't seen so much. I mean, investors are happy because with the buybacks, their share price goes up. So there's no one to really complain about it. Like kind of the idea that, say, CBA shouldn't be returning the money because it should have some good ideas for things to invest in. No one's going to be complaining if you don't already own the company. But if you already own the company, then you're benefiting from the share buyback. So you're not going to kick up too much of a stink, I think is sort of the thing. But the other thing is a lot of this money was emergency funds. So when COVID hit, a lot of companies issued capital and said, like, looks like there's some rough times ahead. We're gonna raise money while we can, get a bit of a war chest together and ride out the storm. And in the end, there wasn't a storm, and they had a great year. And so a lot of what's going back is this emergency capital that they just didn't need. And like, well, we don't actually need this, so we're just going to send it back.
Right.
So that's going on. But it's interesting now. Like, we're going into another round of lockdowns, and probably into a double dip recession. It's like, well, are you sure you don't need that emergency capital now? Like, things look a little rocky. And the other, like, one of the interesting stories this week was AGL. So AGL came out and had a pretty disappointing result. Share price fell further. Just a lot of troubles that they're in. They're raising $400 million with a dividend reinvestment plan. Some analysts expect they're going to have to raise another $400 to $500 million in fresh equity as well. But AGL did a share buyback of 620 million in August 2019.
Right, just before COVID kicked off.
Yeah, just before COVID. So they bought back 620 million in August 2019. 2 years later, they're having to raise money again, potentially sell equity. So one of the things I talk about with buybacks is, like with AGL's case, they bought back at when their share price was around $18. It's currently around $6. So they're buying at 18 and then selling at 6. And I don't want to overwhelm you with a complex trading concept here, but if you're buying high and selling low,
no, I am all too familiar, Thomas, with this concept. It's my modus operandi that I run in my portfolio.
That's how you day trade your super. Buy high, sell low.
That's right. No, I'm all across the buy high, sell low model. That's a three-bagger.
Three-bagger.
As we call it, as I call it.
So yeah, one analyst was saying it's not a great idea. And you tend to buy back when things are going great. You got heaps of money and your share price is up because everything's going great. But then you're issuing when things are tough and you need the money. And so you're necessarily buying high and selling low. Maybe that's not great, but no one's too stressed about it. I think everyone's happy. Share prices are booming along. Everyone's getting their money. Dividends are up. It's happy days as far as most people in the markets are concerned. And if there's, it's 2022's problem if things go wrong.
2022 and AGL shareholders' problem, it would seem. All right, let's take a short break there, grab a word from this week's sponsor, and we'll be back with more after this. Welcome back. You're on Comedian versus Economist. Don't forget you can check us out on Facebook and Instagram at CVE Podcast. Thomas, China is uninvestable. Is this true?
Yeah, well, Ambrose Evans Pritchard reckons it is. He's the finance editor at the Telegraph in the UK. He had a piece the other day saying that it's uninvestable. Right. Yeah, there's just too much sovereign risk at the moment. And we're seeing this with, so they're cracking down, the tech sector's copying it. The tech US market's lost 1.2 trillion since mid-Feb. It's down. Tencent and Alibaba are both down 40% from their highs. And those two make up 10% of the MSCI Emerging Markets Index. So if you're in an ETF of MSCI Emerging Markets, you could be down 10% just on those two. Yeah, and so China's cracking down on the tech sector and a bit more generally as well.
Are they an emerging market?
Yeah.
Really? They seem pretty settled over there in China. It seems like they've... I don't know. I'm surprised. I don't know a lot about this stuff, obviously, painfully, obviously, but I would have thought that they're a fairly well-established economy, a fairly well-established market, that they wouldn't be seen as emerging anymore. They've emerged, haven't they?
Well, yeah, some, but they're still urbanizing their population. There's still people coming in off the farms and into the cities. It's not. The sort of process of development in the sort of classical sense isn't finished in China.
I think maybe it's a question I'll ask the equity mates guys, or maybe see if they can cover it off about what the definition of an emerging market is. I mean, unless you know.
It's kind of a macro question, but sure, you want to talk to those guys or whatever. No worries. It's just economics and macro, but that's fine. Talk to the equity mates guys. Your buddies.
All right. Well, what's your definition of an emerging market?
I don't know what the technical definition is.
So I go to equity mates for my investing info.
But no, okay. So they're cracking down. So there's three stories doing the rounds about why this is going on. And it depends on which camp you think is going on. It depends on how much exposure you want to have to China. So the first story is that China is just plugging gaps and they're making sure there's no strategic vulnerabilities coming through the corporations. So, and saying it's in response to America had the America's Holding Foreign Companies Accountable Act. And basically, if you're a director of a company that's listed in the US, then you've got to disclose a whole bunch of stuff. But the directors of the big companies all have political and military ties in China, so it sort of opens this door that China didn't really want opened. And also now that China has sort of taken control of Hong Kong, they kind of want to get people out of China, out of the US market and into the Hong Kong market. where they have more control over it. And that's sort of the idea, is that they're just shoring up some strategic vulnerabilities, and it's not too big a story. It's not something to be worried about too much. They're just moving companies away from America back closer to home. Still happy days, still lots of upside for Chinese companies. That's story one. Story two is that it's a fairness and equity consideration. So what they're doing is they're making sure that these big companies in China don't get too big, or so big that they start distorting the political process. And they would say like, look to America and say, you look at the lobbying that goes on in Washington from big tech or from big pharma or whatever, the big whatevers, that distorts the political process, and that creates unfair outcomes for its people.
That seems like a double-edged sword, though. Like, I mean, I get it. You don't want these big companies wielding too much political power. But at the same time, the bigger they get, the more jobs they create, the more income they bring in, the more tax they pay. Well, maybe not, depending on where they're housed. But
yeah, I mean, it's not immediately obvious that one big company employs more people than 5 small companies.
Yeah, fair enough.
Like, it kind of depends on how it tracks up. But it's definitely true that one big company exerts a lot of political power, more political power than 5 small companies. And America has a history of this. So Roosevelt, he took on the Rockefellers and the JP Morgans and broke up Standard Oil and US Steel and the railway monopolies, and tried to sort of, make sure that corporate power wasn't consolidating too much and creating a sort of oligarchy. And so the story goes, this is just China's version of that. And it's ultimately going to be a good thing because you have a more fair and equitable society. Goldman Sachs was reporting on this, ironically, one of the richest investment banks in the world. They're saying, from a long-term macro perspective, the new regulations could potentially lead to a more balanced economy in terms of growth drivers and resource allocation, less inequality, which is conducive to aggregate consumption growth, foster fairer competition, which is crucial for innovation and creativity, and lower systemic risk in the highly leveraged sectors. So happy days. That's story 2 as well, saying it's a good thing. It's a bit of pain now. They're getting on top of the companies. The big companies going to have to take a bit of a hit, but the Chinese outlook in the long run is going to be all the better for it. Yeah, that's story 2.
Okay.
Story 3 is the sort of the Ambrose Evans Pritchard line, which is like, that's not actually what's going on. What you're seeing is a consolidation of political power under Xi Jinping. It's just about grabbing hold of power and making sure that there's no political, rivals emerging out of the Chinese political ecosystem. And it's about sort of totalitarian control. I had a quote here from Dominic Armstrong, who's from the Emerging Market Fund, Horatius. The Communist Party will destroy all value if that's the cost of protecting their strategic control. They won't plan to do this, but they are ready to go there if necessary. So they're willing to go hard, create a bit of pain in the short term, bust up some big companies, even their best performing companies, as long as that means that they keep hold of political control.
Right. I mean, story 1 and story 3 sound pretty similar. Like, neither of those stories are great for the big companies.
No, I mean, no. In story 1, they're happy with the big companies being big. They just don't want them in America, opening up a window from America into China. So it's like, happy with what you guys are doing. Just want you got in Hong Kong rather than America, because then we feel safer. Otherwise, business as usual, carry on. Story 3 is back in your box. We're going to hit you on the head, get you under control because you're getting a bit big for your boots.
Right. Okay. Yeah, makes sense.
And so that's why Evans Pritchard is saying, like, it's uninvestable. There's too much sovereign risk now, because if a company starts to do well, then it can find the rug taken out from underneath it. And you saw this with the education sector in China, like that wasn't even a particularly big sector, like with big companies, but there was some good profits going on for some companies, but they just got sort of with the rule of law wiped out overnight. Yeah.
So we talked about back in the very early days of this podcast. We did, I think, the first 6 or 7 episodes were on the sort of foundations of economics, and we talked about share market value and how it's always forward looking. And I guess it makes it really hard to think about what a company might be worth in the future if you don't know that at any point the government might come and just kind of shut down operations in one way or another. Like, it's easy to look at a small company in Australia and you think, wow, they're going to do some really amazing things. They've got this really long runway of profit ahead of them or whatever. I guess you can buy into that company with a bit more certainty. Whereas in China, I guess what he's saying is, you don't know what's going to happen. And so therefore you can't put your money there at the moment, at least, because it could all be taken out at, as you say, the rug could be pulled at any point and then it all comes crashing down. Yeah, exactly. And it's it's even trickier than that, because those three stories, like, I don't know which is true. It's probably unknowable. A lot of smart people setting up in each of those camps, but there is uncertainty there. You don't know what the reality is. You don't know what the outlook is. So it is quite hard to sort of value a Chinese company in that context, because you kind of don't know. There's just so much uncertainty there. But yeah, it's definitely things are changing. So, 5 years ago, we're talking about, the Chinese century and China joining hands with the West and walking into a golden future of trade liberalization. And that's what me and my mates were talking about, value. That's for sure.
Yeah. But that's not, no one's talking about that anymore. Now it's a Cold War, effectively. Like, people at Cold War worried that it's going to go hot. So that's the new reality we have, and that change has happened very quickly. Yeah. Like, 18 months. Like, it's been a really remarkable shifting of the political poles.
Yeah, well. All right, look, we got some listener emails to get to before we finish up. Really love getting your emails, guys. Keep them coming through. CVE@equitymates.com, or you can hit up the website equitymates.com/CVE. Jeff sent us an email, says, love the show. Listen to the special superannuation show on Saturday. That was part of our Super Saturday series, thanks to Superhero. I noted the point that one of the original perceived benefits of super was investing capital in new infrastructure and businesses to help grow Australia. Lately, it looks like all they are doing is buying existing listed assets, e.g. Sydney airports, and taking them private. Does this crowd out the traditional investment community, like us retail investors? Thomas?
Yeah, it's a good question. Not exactly. So you kind of think about this idea that money going in anywhere goes everywhere. So if they're investing in particular, like in infrastructure assets, that means anyone in a sort of comparable space trying to raise money for infrastructure assets is going to be able to do it more cheaply. They're going to be able to get more money. There's more money available for infrastructure. So the big super funds might displace people. So they come in and they buy Sydney Airport, say, but that probably means that whoever was going to buy Sydney Airport then looks for another infrastructure play. Right. And that other infrastructure play might be a new piece of infrastructure rather than an existing piece of infrastructure. So money going in helps the whole space. And it does help create new infrastructure, even if the super funds aren't directly buying new infrastructure.
Is there a different profile, though, of companies who are prepared to build new infrastructure or invest in new infrastructure compared with those who might just buy existing assets? Like, is it a bigger gamble to invest in new infrastructure? Yeah,
it is. It is, I think. But it helps knowing that there's super funds to sell to ultimately.
Yeah.
Do you know what I mean? Like, if I can create a nice piece of good long-term infrastructure here, so there's some super funds going to fall over themselves to buy it.
Sweet bridge or something.
Yeah.
I know what it looks like. Fair enough. All right. Thanks, Jeff, for your email. Willard wrote in. He was listening to you talking about the book last week. I forget which one
Thinking
it was.
Fast and Slow, I think.
Thinking Fast and Slow. Justin Thomas's comment on Thinking Fast and Slow. I didn't pick up that was the title of the book. I also read the book and think it's filled with some great insights into how we think and behave. Some of the ideas in the book have been regarded as a bit of a stretch. Notably, most of the studies that Kahneman didn't orchestrate. Thomas, are you just plying us with conspiracy theories from some crackpot of... You said the book is nearly 10 years old. A lot of the studies referred through are even older. It sounds like... Oh, no. Point is that there's some other books out there that could tickle your fancy. Nudge, final edition. How to Change Milkman and Predictably Irrational by Ariely. Keep dancing, lads. Thank you, Willard. I will keep dancing. Have you read any of those other books? Well, first of all, Thomas, Thinking Fast and Slow. Any comment on the fact that Willard thinks you're a conspiracy theorist?
No, it's a fair point. I mean, it's a fascinating. It's worth reading, just for the way he tries to set up these experiments. So he has this idea that people will react in a certain way to particular incentives. So then he tries to set up an experiment that controls the scenario just to measure the particular incentives. So it's fascinating thinking about how you set up experiments like that to test those hypotheses. And then his description of the way the brain works with these two functions, the fast thinking, light and sort of like impulse driven versus slowing down and thinking calculatedly, is a very useful framework. Even if it's not the complete picture, it's very useful. And it's a great book. I still recommend it. I think he does as well. He loves the book.
I think it should be noted it's just me calling Thomas a conspiracy theorist.
Yeah, but thanks for those other tips. I've heard of Nudge. I haven't heard those other ones, so I'd be very curious to see. But there's where I love that space where psychology meets economics. It's a really fascinating space.
Yeah. So if anyone else is interested, that was Nudge, How to Change by Milkman, and a book called Predictably Irrational. If you're interested in following up any of those. I don't really read, so I'll leave those to someone else. All right, finally, Clement, thanks for your email. I love the podcast. You mentioned Bernie Madoff last week, and I would like your opinion on how likely it is that a new Bernie Madoff is stealing people's life savings now as we speak, and are we safe from those bad practices in Australia? So Bernie Madoff famously invented the Ponzi scheme. Is that right?
No, that was Charles Ponzi.
That makes a lot more sense.
Makes more sense now. Yeah. No, Bernie Madoff just had a particularly sophisticated Ponzi scheme.
Bernie Madoff, I think, invented the... He made off with lots of money. Sorry, there's no saving me from that. I even knew about the Ponzi scheme thing. Yeah. God, this must be late. Yeah. Apologies, everyone.
In terms of Ponzi schemes, so remember, a Ponzi scheme is a scheme where the money coming in from new investors pays out the return of the existing investors. And there are the company itself is not making the scheme itself is not making any money. It's not generating any money. It's only that flow from new investors to existing investors that creates the returns. And then once the flow of new investors dries up, then the scheme collapses. And that's what the Ponzi scheme did. And so that's what we're talking about with the Ponzi scheme. And so we're much more clued on to Ponzi schemes as a concept now, and we have a much better insight into the way schemes work, apart from Bitcoin, obviously. But so like those sort of raw kind of scams, I don't think are really such a big worry. And like even with the Royal Commission into the banking sector, like they uncovered some pretty dodgy stuff, but nothing like whole-scale fraud like a Ponzi scheme. There were some shady practices, charging dead people for advice they never received, stuff like that. But it wasn't like a wholesale Ponzi scheme where they're just fleecing people. And we do have, whole systems set up to try and stop that kind of stuff happening. But, build a better mousetrap, they build a better mouse. So we'll see.
And I saw a stat a little while ago around the increasing price of cybersecurity insurance, and it's gone like through the roof. So there's never a shortage of scams around, particularly when you talk about cybersecurity, they're everywhere. So ransomware attacks and all those kinds of things that are more prevalent than ever. So we might be
make sure you write down your passwords.
This is just trying to trigger me. So definitely scams around, but hopefully maybe we're as you say, regulation maybe is stopping Bernie from making off with all your money, as it were. I can't even get the pun right at the end. Oh God! All right.
Quit while you're ahead.
Well, we're ahead. All right. We'll leave it there. Don't forget, if you'd like to send us an email, you can send us your thoughts, comments, questions, cve@equitymates.com or at the website equitymates.com/CVE. Don't forget to check out all the other great podcasts across Equity Mates Media, Equity Mates Investing Podcast. Get started investing. You're in good company. Thomas, you've been good company as always.
Oh, thank you.
Thank you very much for listening, and we'll see you again next week. Bye.
Comedian vs. Economist is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Comedian vs. Economist are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Comedian vs. Economist acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.